Hello. So, there's a common belief that correlation and concentration within a portfolio are actually the same thing. Now, a trader may account for one, therefore assume that their portfolio is well diversified. However, this is a misunderstanding and there are some hidden risks that need to be considered. Therefore, we're going to have a look at a simple example now. So here we have two portfolios, portfolio A and portfolio B. Portfolio A has 5 positions, and all of those 5 positions are within the technology sector. This means that they are all linked to one market theme, which is technology. And therefore, the risk would be considered highly concentrated, as you can see, within the technology sector. In comparison, you've got portfolio B, which again has 5 positions, but this time they are related to 5 different sectors. And the difference is that they are linked to 5 different market themes. But what's not known at this level is that underneath they are all cyclical sectors that are linked to the same economic driver, which is economic expansion. So this means that they move together and they're considered to be highly correlated. So what this means is that in the event of an adverse market event, they may all move negatively against you. So in isolation, both of these two portfolios may seem to be well diversified, but when larger drawdowns start to become experienced, it's to do with losses clustering together in relation to concentration or correlation. And it's all to do with unexpected risk exposure at the portfolio level. So it's important to maintain the stability of the portfolio at all times. So we're now going to expand on that structural explanation in more detail. So from a structural perspective, correlation relates to the relationships between the positions, whereas concentration relates to the risk exposure to one market theme. So they are different concepts, although they do have common market drivers. Therefore, when looking to take an additional trade, it's important to ask, is this trade already expressed within another form? Is the risk exposure too high for me to add this trade? How dependent are the positions on each other? And if this trade was unsuccessful, how would it impact the portfolio? And these types of questions draw out potential scenarios that can be planned for ultimately. So overall, this highlights that diversification is more about the quality, and this can be achieved with an awareness of the risk exposure at any one time, and this helps to formalize the portfolio structure by understanding how risk should be allocated across the portfolio. So, if you'd like to learn more about portfolio structure or structural analysis, then I provide additional information in the description below. Thanks for watching, and I'll see you soon.